Imagine your hard-earned money slowly melting away, like ice under a hidden flame. Not stolen in a dramatic heist, but eroded quietly, year after year, by a force most people ignore until it's too late. Watch to the end, and you'll see exactly how the world of 2026 will separate those who preserve their wealth from those who lose it without even noticing. The International Monetary Fund has released its forecast for global inflation in 2026. This map paints a stark picture of winners and losers across the planet. The world average sits at 3.7%, a number that sounds tame until you realize what hides at the extremes. Look at Venezuela. The forecast shows 682.1% inflation. Your savings there would lose almost everything in a single year. Prices doubling, tripling, then exploding beyond control. This is hyperinflation, a collapse that turns money into meaningless paper almost overnight. Sudan follows at 54.6%, Iran at 41.6%, Myanmar at 28%. These nations sit in the danger zone where daily life becomes a struggle for basics. Bread, fuel, medicine, all racing out of reach for ordinary people. Now shift your gaze to the other end. Brunei, Liechtenstein, and Switzerland all forecast just 0.6%. China at 0.7%. Thailand and Bahrain close behind. In these places, prices barely move. Money holds its value, and planning for the future feels safe. The United States projects 2.4%, close to the Federal Reserve's target, yet still above it. Every dollar you hold loses a small slice each year. Canada at 2.0%, the United Kingdom at 1.8%, Japan at 2.1%. Stable, predictable, but never truly standing still. Across Europe, most countries cluster between 1.5 and 2.5%. Germany, France, Italy, all in calm waters. Russia stands higher at 5.2%. Australia at 3.0%. New Zealand at 2.1%. Comfortable for now, but nothing is guaranteed forever. South America tells a different story. Argentina at 16.2%. Haiti at 26.2%. Nigeria at 22%. Turkey at 24.7%. These are economies under pressure, where political choices and external shocks hit hardest. The bottom 10 show remarkable control. El Salvador, the Bahamas, Fiji, all near or below 1%. Places where central banks have tamed the beast, where savers sleep easier, and businesses can plan years ahead without constant recalculations. Notice China at 0.7%, a giant economy flirting with deflation. Low inflation sounds good, but too low brings its own risks. Consumers delay purchases, waiting for lower prices. Growth slows. Debt becomes heavier in real terms. Switzerland, Liechtenstein, Brunei, small, precise, disciplined. Strong currencies backed by stability. Their low numbers reflect decades of careful policy. Trust in institutions that deliver predictability. Venezuela's 682.1% did not appear overnight. Years of mismanagement, sanctions, and loss of confidence created the perfect storm. Once one of the richest nations in South America, now a warning written in massive numbers. The map uses color to show the gradient. Light yellow for the lowest rates. Deep purple for the highest. Gray where data simply does not exist. A visual reminder that inflation never distributes its pain evenly. Developed nations aim for around 2%, enough to grease the wheels of commerce, not enough to scare savers. Most achieve it in 2026. The United States slightly above, but trending toward control. Emerging markets face greater volatility. Commodity dependence, political risks, currency weakness. All amplify price swings. Nigeria, Malawi, Yemen, all paying the price for structural challenges. Inflation is the silent tax on cash. Leave money in the bank, and its purchasing power shrinks. In low-inflation countries, the erosion feels gentle. In high-inflation ones, it becomes a torrent that sweeps away lifetimes of work. Real assets often become the refuge. Property, commodities, equities. They tend to rise with prices, but only if you choose wisely and time correctly. In hyperinflation, even those can fail if the entire system collapses. Gold has historically preserved value during chaos. Bitcoin and cryptocurrencies claim the same mantle in the digital age. Yet both carry their own volatility. Nothing offers perfect safety, only different trade-offs. Central banks wield the primary weapons. Interest rates, money supply, currency interventions. When they act decisively, inflation stays contained. When they hesitate or politicize decisions, the monster grows. The 2026 forecast shows a world still healing from recent shocks. Supply chains disrupted. Energy prices volatile. Geopolitical tensions simmering. Yet most nations appear headed toward calmer waters. The outliers demand attention. Venezuela's number is so extreme it distorts the scale. Without it, the highest would be Sudan at 54.6%. Still devastating, but on a different order of magnitude. Myanmar, Burundi, Haiti, all above 26%. Conflict, natural disasters, weak governance. Common threads behind the highest readings. Stability breeds low inflation. Chaos breeds the opposite. Look again at the bottom. 10 countries below 1.1%. A mix of oil-rich states, financial havens, and disciplined economies. Their success comes from policy choices made years earlier. China's low forecast reflects aggressive control. Deflation risks loom, but authorities prioritize stability above rapid growth. A calculated trade-off in a slowing economy. The United States at 2.4% signals the Federal Reserve's work is nearly complete. Rate cuts likely ahead if the forecast holds. Borrowers benefit. Savers pay the price. Europe largely tamed its post-pandemic surge. Energy crisis managed. Supply shocks absorbed. Most countries backed near target, allowing focus on growth rather than firefighting. Russia's 5.2% reflects the cost of conflict. Sanctions, isolation, military spending, all feeding price pressures that citizens feel daily. Australia and New Zealand, island nations with strong institutions, both near 3% or below. Commodity exporters benefiting from global demand while maintaining discipline. The map reveals patterns beyond raw numbers. Stable governance correlates with low inflation. Resource curses and political turmoil correlate with high. No perfect rule, but the trend is clear. Personal finance changes dramatically depending on where you live. In Switzerland, cash under the mattress loses almost nothing. In Venezuela, it becomes worthless in months. Expatriates, investors, digital nomads, all must factor location into their plans. A high salary means little if local prices devour it. Real wealth is purchasing power, not nominal digits. The IMF forecast assumes no major new shocks, no escalation in conflicts, no collapse in trade. Reasonable baseline, but reality rarely follows scripts. Prepare for both scenarios. Build resilience into your finances. Diversify across currencies, asset classes, geographies. The countries with lowest inflation did not achieve it by accident. They built institutions that prioritize sound money, independent central banks, fiscal discipline, open trade, lessons available to any nation willing to apply them. Individuals can apply similar principles. Live below your means. Invest in productive assets. Maintain liquidity. Avoid excessive debt that becomes crushing when rates rise. Inflation is not random. It reflects deeper choices: monetary policy, fiscal responsibility, global position. The 2026 map is a report card on those choices. Venezuela failed spectacularly. Switzerland succeeded quietly. Most nations fall somewhere in between, muddling through with mixed results. Your personal economy operates under the same rules. Spend less than you earn. Invest the difference wisely. Protect against erosion of purchasing power. The world average of 3.7% means the typical person loses that much buying power yearly. Compounded over decades, the loss becomes substantial. Time amplifies small percentages into large differences. Start early. The countries with lowest inflation benefit from decades of good decisions compounding. The same principle applies to personal wealth. 2026 approaches. The forecasts are set. The choices remain yours. Understand the landscape, position yourself accordingly, and watch your wealth respond differently than those who remain unaware. This is not about fear. It is about clarity. See the world as it is, not as you wish it to be. Then act with deliberate intention. The silent erosion continues daily. In some places, barely noticeable. In others, catastrophic. Your awareness determines which category you occupy. Master this force, and you master one of the most powerful influences on wealth creation. Ignore it, and you join the majority who wonder where their money disappeared. High inflation does not strike randomly. It emerges from precise failures, repeated choices that erode trust in money itself. Examine the top of the forecast, and the patterns reveal themselves clearly. Venezuela leads at 682.1%. Decades of excessive money printing to finance deficits, combined with collapsed oil production and international sanctions, destroyed confidence in the bolivar. When a currency loses credibility, prices explode as people rush to exchange cash for anything tangible. Sudan follows at 54.6%. Ongoing civil conflict disrupts food production and supply chains, while the government finances war through the printing press. Instability breeds scarcity, and scarcity drives prices upward in a vicious spiral. Iran projects 41.6%. Heavy sanctions restrict oil exports and access to foreign currency, forcing monetary financing of budget shortfalls. The rial depreciates sharply, importing inflation through higher costs for goods and energy. Myanmar, at 28%, reflects the aftermath of military coup and internal conflict. Sanctions, disrupted trade, and loss of institutional credibility push the central bank toward loose policy. Economic isolation compounds the damage. Haiti, Burundi, and Yemen share similar threads. Gang violence in Haiti, political repression in Burundi, prolonged war in Yemen. All shatter production, block imports, and force governments into desperate financing measures that fuel price surges. Turkey at 24.7% stems from unorthodox monetary policy in prior years. Keeping interest rates low despite rising prices eroded lira value and embedded inflationary expectations. Recent tightening offers hope, but the legacy lingers. Nigeria and Malawi face currency pressures from commodity dependence and fiscal deficits. Oil price volatility in Nigeria. Weather shocks in Malawi. Both amplify imported inflation when reserves run low. Argentina, at 16.2%, carries scars from chronic deficits and debt defaults. Though improving, past mistrust keeps expectations high, making disinflation painfully slow. High inflation always traces back to excess money growth outpacing economic output. Demand pull from spending, cost push from shortages, or built-in expectations from past failures. In extreme cases, all three converge. Conflict ranks among the most reliable triggers. War destroys infrastructure, displaces workers, and diverts resources to destruction rather than production. Sudan, Myanmar, Yemen all pay this price daily. Sanctions act as external shocks. They limit trade, freeze assets, and force reliance on domestic printing. Iran and Venezuela illustrate how isolation accelerates monetary expansion. Weak institutions complete the triad. When central banks lack independence or prioritize short-term goals over price stability, credibility vanishes. Once lost, it takes years of discipline to restore. Notice the absence of high-inflation developed nations. Strong institutions, independent central banks, and fiscal rules create buffers. They absorb shocks without resorting to the printing press. Emerging markets remain vulnerable precisely because those safeguards are fragile or incomplete. Political pressures override technocratic decisions. Short-term relief trumps long-term stability. Hyperinflation, like Venezuela's, represents the endgame. Confidence collapses entirely. People abandon the currency, prices adjust hourly, and savings evaporate. Recovery demands radical measures: dollarization, new currency, or total policy overhaul. Even moderate high inflation, above 20%, grinds down the poor hardest. Fixed incomes lag, food and fuel become luxuries, social unrest follows. The human cost hides behind the percentages. Central banks in stable nations target 2% for a reason. Low enough to protect savers, high enough to avoid deflation's traps. Deviate too far, and the consequences compound. The 2026 forecast shows these failures persist. Venezuela did not arrive at 682.1% overnight. It resulted from choices accumulated over years, ignored warnings, and delayed reforms. Sudan and Yemen remain trapped in cycles of violence that no monetary policy alone can break. Peace precedes stability. Without it, inflation becomes inevitable. Iran's path highlights external constraints. Sanctions bite, but domestic policy choices determine how deeply. Tighter fiscal control could ease the pressure even under restrictions. Turkey offers a counterexample in progress. Recent orthodox shifts have begun bending the curve downward. Discipline works, but only if sustained. Individuals in high-inflation environments adapt brutally. They hold foreign currency, buy assets daily, minimize cash balances. Survival demands constant vigilance against the erosion. Investors avoid fixed-income securities in such places. Equities may rise nominally, but struggle with uncertainty. Hard assets like gold or real estate become preferred stores of value. The lesson cuts deeper than economics. High inflation reflects governance failures. Where institutions serve power rather than people, money pays the price. Stable nations maintain low inflation through deliberate restraint. Independent central banks, transparent rules, and political consensus on sound money. These are not accidents. Your location shapes your exposure. In Switzerland or Brunei, inflation barely registers. In Venezuela or Sudan, it dominates existence. Global capital flows toward predictability. Countries that master inflation attract investment, talent, growth. Those that fail repel them. The 2026 map is not fate. It projects current trajectories. Change the policies, and the numbers follow. Nations recovering from high inflation share common steps: fiscal discipline, central bank independence, open trade, painful at first, transformative over time. Argentina's recent efforts show early signs: tight budgets, rate hikes, credibility building. The path exists for any nation willing to endure the transition. Personal finance mirrors national policy. Spend beyond means, Borrow excessively, ignore erosion, and wealth vanishes. Live within limits, invest productively, protect purchasing power, and it compounds. Inflation exposes illusions. Nominal wealth means nothing if prices devour it. Real wealth endures only through assets that outpace the erosion. The highest rates in 2026 serve as warnings. Ignore the underlying causes, and any economy can slide toward them. Stability is earned daily through restraint and foresight. Lose it, and recovery demands sacrifices most leaders avoid. Watch these nations closely. Their struggles illuminate the fragile line between control and chaos. Your choices determine which side of that line you occupy. Awareness is the first defense. Action is the only guarantee. Low inflation does not arrive by chance. It emerges from deliberate restraint, institutional strength, and policies that prioritize long-term trust over short-term gains. Examine the bottom of the forecast, and the hallmarks of success become unmistakable. Brunei, Liechtenstein, and Switzerland all hold at 0.6%. Small nations, yet masters of control. Brunei leverages oil wealth with conservative spending. Liechtenstein and Switzerland build on centuries of financial prudence, strong currencies, and independent central banks that refuse political interference. China projects 0.7%. A deliberate choice by authorities to anchor expectations amid slowing growth. Aggressive sterilization of excess liquidity, strict capital controls, and a focus on stability over stimulus keep prices in check. Thailand and Bahrain follow closely. Resource-rich economies that learned from past crises. Fiscal buffers, floating exchange rates, and proactive rate adjustments prevent spillovers from global shocks. El Salvador, the Bahamas, Fiji. Diverse paths to the same outcome. El Salvador's dollarization eliminated monetary mischief entirely. The Bahamas ties its currency to the dollar for imported discipline. Fiji maintains tight oversight in a small, open economy. Low inflation reflects credibility earned over decades. Central banks that hit targets consistently build public trust. When people believe prices will stay stable, they do not demand higher wages or rush spending, breaking the spiral before it starts. Independent institutions form the foundation. Switzerland's central bank answers to no politician. Decisions follow data, not elections. The result speaks in single-digit decimals year after year. Fiscal discipline completes the picture. Nations that live within revenues avoid borrowing binges that force money creation later. Brunei invests oil proceeds wisely rather than spending recklessly. Liechtenstein runs perpetual surpluses. Oil wealth helps some, but only when managed well. Compare Brunei to Venezuela. One preserves value, the other destroyed it. The difference lies in governance, not geology. Developed economies cluster near 2% by design. The United States at 2.4%, Canada at 2.0%, Europe mostly below. Lessons from the 1970s stagflation burned deep. No major central bank tolerates sustained overshoots anymore. Japan's 2.1% marks a quiet victory. Decades fighting deflation finally yield mild inflation without excess. Careful calibration after years of trial and error. Low inflation protects purchasing power. Savers earn real returns. Borrowers face predictable costs. Businesses invest confidently, knowing input prices won't surge unexpectedly. Yet extremes bring hidden dangers. China's 0.7% flirts with deflation's edge. Consumers postpone purchases expecting lower prices tomorrow. Debt burdens grow heavier in real terms. Growth stagnates as demand weakens. Switzerland avoided that trap through precise targeting. Enough inflation to lubricate the economy, never enough to erode savings. A narrow path walked masterfully. The bottom 10 represent quiet triumphs. No headlines celebrate 0.6%. No crises demand attention. Stability rarely makes news, but it builds wealth silently over generations. Contrast sharpens the lesson. Venezuela prints money to fill gaps. Switzerland refuses. One ends at 682.1%, the other at 0.6%. The gap measures more than numbers. It measures trust. Individuals can borrow these principles. Treat your personal finances like a low-inflation central bank. Set rules, follow them religiously, prioritize credibility with yourself. Live below your means consistently. Build buffers against shocks. Invest in assets that compound without constant recalibration. In low-inflation environments, fixed income shines. Bonds deliver real yields. Cash retains value. Long-term planning becomes reliable. High-inflation zones demand different armor. Minimize cash holdings. Convert earnings immediately into hard assets. Foreign currency becomes a lifeline when local money collapses. Gold has proven its role across centuries, immune to printing presses, scarce by nature. In Venezuela, those who held it preserved wealth while paper vanished. Real estate often follows prices upward. Productive land, rental properties. Yet in chaos, even property can lose liquidity or face seizure risks. Equities offer growth potential. Companies raise prices with inflation, protecting profits, but only in functioning markets. Hyperinflation destroys stock exchanges along with everything else. Cryptocurrencies promise digital gold. Borderless, finite supply. Some adopt them as escape valves in restricted economies. Volatility remains the price of entry. Diversification spans the spectrum. No single asset survives every scenario. Spread across currencies, classes, geographies. The goal is resilience, not maximization in calm times. Location becomes a portfolio choice. Digital nomads chase low-inflation havens. Remote workers earn dollars while living where prices barely rise. Purchasing power multiplies without higher income. Expatriates in Switzerland or Singapore enjoy compounded advantages. Salaries hold value. Investments grow undisturbed. Small differences accumulate into vast gaps over decades. Back home, even modest inflation demands response. The United States at 2.4% seems mild. Yet over 30 years, it halves purchasing power. Compound interest works both ways. Invest ahead of the erosion. Equities historically outpace inflation by wide margins. Quality companies, broad indexes. Time turns small edges into fortunes. Retirement planning hinges on real returns. Assume 2 to 3% average inflation. Build portfolios that deliver 7 to 8% nominal to preserve lifestyle decades from now. Debt strategy flips with the environment. In low inflation, fixed-rate borrowing locks in cheap money. In high inflation, debt erodes naturally as wages and assets rise. Central banks will not save individual savers. Their mandate protects the system, not your specific wallet. Personal vigilance fills the gap. The 2026 forecast offers a menu of outcomes. Choose your environment wisely. Position your assets accordingly. Let compound effects work in your favor. Nations at the bottom succeeded through restraint. Individuals succeed the same way. Delayed gratification, consistent rules, protection against erosion. High inflation punishes the unprepared brutally. Low inflation rewards the disciplined quietly. The difference compounds into entirely different lives. Awareness changes everything. Most people notice inflation only when it hurts. By then, wealth has already leaked away. Act before the pressure builds. Build systems that preserve value automatically. Habits that outlast motivation. The map shows destinations. Policies drive the journey. Your personal policies determine where you arrive. 2026 will test every choice. Economies will drift along projected paths unless leaders intervene. Individuals face the same inertia. Break it deliberately. Align with stability. Distance yourself from chaos. Wealth is not what you earn. It is what you keep. Inflation decides how much remains. Master its dynamics, and you control one of the greatest forces shaping financial destiny. The numbers fade. The principles endure. Choose restraint. Choose foresight. Choose preservation. Your future self will measure the difference in more than percentages.